Well, good morning, everybody, and welcome to episode 85 of Retuning Your Firm. And today's theme, as you can probably see in front of you, is keeping your bankers happy. I'm Richard Chaplin, and I'm really pleased to be your host. So what are we going to be covering today? Well, as you probably gathered, the UK is predicted to be in economic recession for much of 2023, escaped by the narrowest sliver today, because apparently ONS said that we are now flat for the last 3 months, but December's looking pretty scary. And but of course, as we know, that's only the first set of data, and they'll probably change their mind in a month or so's time. So what we're looking at today really is, I guess, is financial management. And the point is that as revenues flatten and costs keep rising, that puts more pressure possibly on those involved in the financial management dimension, and or those who actually help facilitate the troughs and highs, which is inevitably what happens in cash flow management. And so I'm delighted that we've got two excellent guests today: Steve Rowan, who's the Chief Financial Officer of RBC, and I'm going to introduce him properly in a minute, and equally John Aldred, who's the Industry Director at Barclays Bank. And I've asked them to share some tips on how to ensure your firm keeps its bankers happy, which is a nice broad topic. Unfortunately, as I think you may have seen in my note, Francesca Lagerberg, my regular co-host, is unable to join us on this episode. So before I move on to talk about the sort of John, and just quickly some forum news. If you're not watching the videos from the past shows, absolutely please do. Well, there are hundreds of them, literally, and we've got a new search engine under development, so please look out for that too. Awards, International Management Excellence Awards, the submissions are due by the end of February, and the online ceremony is on the 15th of June. So if you're looking to make a submission, don't miss that deadline. So it's the end of this month. The Winter 22 Sector Trends Tracker, if you recall, we ran that on the show for many months, but now it's been run through a formal research panel. And we had a nice piece that appeared in City AM this week, and also some trade media, I believe, are going to be running it too. And we're getting a lot of impressions and likes on social media for a post that went up. So do have a look at that Sector Trends Tracker. There's a very interesting piece in the FT yesterday, which says that the professional services is the sort of the driver of growth in the London economy and in the other sectors as well, which I suppose I kind of guess we knew anyway, but it's just nice to see it in that august publication. And then finally, Mentor Match. If you're not thinking about being a mentor or looking for a mentor, then fair enough. But if you are, then do think about Mentor Match. It's a free program, and it matches people on a fairly sophisticated algorithm, but also it gives you a nice confidential place for tracking all aspects of the mentoring relationship. So I think that's probably a little bit enough about forum news. So what I'm going to do now, if I may, is I'm going to switch you to our first presenter and our first guest today. And our first guest today, welcome to the show, John, is John Aldred, who's the Industry Director for Business and Professional Services team at Barclays Bank. And he's going to be talking, I think, a little bit about sort of what are the key things that you and your banker might need to be discussing in the current climate, with obviously significant experience as Barclays are a major provider of finance and support generally to professional services. So welcome, John, and looking forward to what you have to say. Over to you.
Good morning. Thank you very much for that, Richard, and good morning, everyone. It's great to be speaking to you today. So I thought I'd start by perhaps just slightly reframing the title for this session. Very news when I saw Richard wants to talk about keeping bankers happy, but obviously, as you'll all be aware, firms have a very wide range of stakeholders to manage, and particularly finance providers. And I'm thinking here particularly about partners, whether that's actually through capital they've injected into the firm or via the undistributed profits that will obviously be sitting in the firm probably for some time after they were earned. And looking back at the PwC survey from last year, I was reminded that certainly for the top 50 firms, less than 10% of their funding actually comes from external funders like banks. And that only goes up to 15% for the rest of the top 100, so the sort of 51 to 100. So, the banking relationship is very important, and we'll talk about that in a moment. But I think anything that Steve and I say here today is equally applicable to other stakeholders, and I say principally the partners, who obviously have a very large vested interest in the health of the firm and its ongoing success. And I suppose the first point I'd make is around communication. clear, open communication at all times, as I'm sure you would do with your partners, is equally applicable to your banker. And increasingly today, I imagine that you will have multiple contact points with your bank or banks. And I suppose another point I'd be keen to make initially is that if you're working with multiple funders, then it's important to treat them equally, or as equally as you feel able in terms of the information that you share with them. Because, as I say, that sort of shared understanding, I think, is very helpful in ensuring you keep them all in a place where they feel able to support you and your firm. And that probably then goes on to the second point that I'd make around transparency. As well, no surprises approach is definitely the best way to operate in my experience. And I think that's no surprises on both sides. Clearly, any news the firm has, whether that's good or bad, is best shared early. And likewise, if the bank has news that it needs to share with you, then it's appropriate that they should be sharing that with you as soon as they reasonably can. If there's a change to a service they're offering you, or if there's a change to the way that service is going to be delivered, then clearly it's important for you and your planning that you're aware of that as soon as possible. So that, I would say, is a very reasonable expectation. But as Richard sort of opened up talking about perhaps the more challenging environment we find ourselves in, and my view would be that nearly all of the firms I work with, if not all of them, are very well prepared for what may come this year. We've been fortunate that whilst the pandemic did cause very significant sort of impacts on the British, UK and the global economy, the professional services sector actually weathered it reasonably well, and the LLP model in particular showed itself to be very flexible, and firms were able to build up cash reserves very quickly. Obviously, we've now entered a period where inflation is much higher, salary pressures have been significant, and some of those cash reserves are now being spent. But I think it's still fair to say that the sector is in good shape. Clearly, we always need to be mindful of clients that we're serving. That obviously us as your bankers, but obviously you as firms, and their demands are always increasing. Their desire to sort of have a broader, more complex service delivered at a lower cost is obviously a challenge that firms need to meet on a daily basis. And that then sometimes does require some flexibility in how the firm approaches its operations and the funding it needs to deliver those operations. And again, I feel that's an area where early engagement with your funders, whether that's your partners or the banks, is very helpful. And I suppose another observation I make is that I think the firms tend to be very keen to know what their peers are doing, or have an understanding of what their peers might be doing, but without necessarily wanting to sort of make direct inquiries, which is completely understandable. But no one seems to want to go first with a new idea or innovation. So I think there definitely are opportunities for firms to do things differently, and realise that sometimes that will require a change in approach to the funding.
Firstly, just can I say that thank you very much for those helpful thoughts, John. I think communication, transparency, and being well prepared as a sector are all things that, in a funny way, we almost take that for granted, but I know from other sectors that's not the case always elsewhere. So I think the relationships I've seen with banks and funders are particularly important. And picking your 85% point, I can see why it's important to keep your 85%, who at the end of the day, technically as the managing partner, you probably report to as well. I'll now, if I may, move to our second guest, and our second guest today is Steve Rowan, and just find him for you. Hang on. So welcome, Steve. Steve is the Chief Financial Officer of a law firm, RPC, many people will be familiar with, very technologically focused business, been growing fast. And Steve's worked in not just UK firms, but also US firms. He's been involved in mergers, and he puts it, discussions around mergers as well. So has a sort of very interesting and long and distinguished track record in our sector. Delighted you can join us today, Steve. Over to you.
Yeah, thanks, Richard, and good morning to everyone in the UK. Good afternoon, anybody who might be to the east. Yeah, thank you. I'm very pleased to be able to be with you today. One of the disadvantages of coming second here on this is that, and particularly an experienced relationship with banks, is that John has basically said, and we've agreed on pretty much most of the things that sort of determine our relationship. So the key things that I've sort of picked up over the years have really been the critical issue of establishing trust as between your the firm or the business that you're running, excuse me, and the providers of finance. So John completely correctly identified not just the banks as interested parties, but in fact any provider of finance, be that the partners in the business or other financiers, maybe lease companies, etc. If that doesn't come under the bank heading. But the key thing really, bearing in mind that what a business wants really is the support of the bank or other providers of finances, is really to have a strong line of communication at all times. I'll come on to a sort of experience of that in a minute, but it's absolutely critical to the bankers to feel that they know what's going on in the business. I'm taking John's words from him there, but basically the flip side of that is for us to give enough information that enables the contact at the bank, excuse me, to feel that they know enough about the direction and current position of the business. And therefore, basically, when going to credit committees, I'm guessing here, but going to credit committees, that feel there's enough information there not to be embarrassed when somebody asks a question and there's no answer. So in relation to creating, regular communication is absolutely key. And through that, I'm hoping that through honesty and transparency, what you do is you create a situation where there's mutual trust. As John said rightly, we want to believe that our bank contacts will support us if we give enough information and they say they're going to support us. So that's, it is about creating mutual trust, and it comes from honesty and belief in each other's truth. John mentioned no surprises. And actually now probably a good time to go to what happened. Say, for example, Richard mentioned it in the pandemic, the start of the pandemic. I think it's right to say that absolutely nobody really knew what was going to happen, and an awful lot of Armageddon sort of conversations were having because nobody knew. So I was very clear with my sort of relationships right at the start to say, look, this is what we think is going to happen. Nobody really knows. But then the key thing was then coming up with a plan for sort of what ifs right at the start of the pandemic, and then sort of going through them and going, well, we don't think that's going to happen, or this is the most realistic situation. But keeping that conversation going at all times. So what actually happened in the pandemic for most places was that things were nowhere near as bad as they looked at the start. And so, we continued, we redid our budgets, for example, because things looked a lot, more rosy, a couple of months in, and so on and so forth. And we just basically kept the bank, informed as the impacts on cash flows as we went along. So, that was one example. So I think John mentioned also, it's on the no surprises list, but basically advance notice. So what I strongly believe is we don't want to put our bank director or indeed our partners under a position where we want their support with 1 day's notice. That doesn't go down very well. So as far as possible, and it's also, to go back to my earlier point, the way you can embarrass your bank director quite easily. So you want to avoid that if you want to get support. So we will look to provide as full a story as we can as to why we might, for example, be seeking a short-term loan or medium-term loan, etc. Or in terms of the general overdraft review meetings that one might have. Give as much detail to make it easy for the director to go to the credit committee to get this rubber stamped or whatever you want. So that's advance notice. More routine business as usual stuff would be timely financial information, relevant financial information and a story around it if that helps to add context. It's all about mutual respect at the end of the day, and providing all of that information. And there really isn't a lot else to say. I mean, it is about people dealing with people, providing the information to allow the other party to make a rational decision, because after all, they are, in the case of the bank, representing a different business, a provider of finance, and in relation to, say, for example, our partners who are providing finance as well, should they provide that finance or additional finance to the firm if we're, say, for example, raising capital, it's key. So I did say at the start that I thought John and I would say pretty much the same thing, but I think that's a good thing in the sense of being experienced in this industry and field. So with that, I think I'll hand back to Richard.
Fantastic. And what I'll probably, I think, do now is put it on. I know I said I will go to gallery mode so that we can all be seen, because there's one of the points that was raised was kind of common to both of you in a way, which was this question of at the beginning of the pandemic, Steve, you were saying that you identified a number of different scenarios that you thought might be ones that would happen. I mean, John, as a banker, I mean, presumably if a firm came to you and said, well, we've got 20 scenarios, but we can't decide which one it is, that wouldn't help you very much. So how would you deal with somebody who comes to you with multiple scenarios?
I think it's helpful to understand the range of possible outcomes. So if you sort of take some of those more extreme examples, what could it look like one way or the other? But, clearly we do need to then work together to sort of drill down to or come to a sort of common understanding of what's most likely to happen, and then make sure the appropriate arrangements are made to cover those. I mean, the pandemic in that sense is a helpful example because, as Steve said, nobody really knew what was going to happen, and those early days were filled with uncertainty, and certainly in my experience was lots of calls internally as we tried to work out how we were going to run the business, and lots of calls with clients who weren't quite sure how much headroom they would need to get through it. But within days, it started to sort of emerge that, and I mentioned the LLP model, that actually there's a huge flexibility in terms of slowing down distributions. Some firms actually slowed distributions and reduced drawings for certain partners, and something that we could all probably keep in mind as we go through this year. It was incredible the progress that was made on managing lockup. That sort of favourite sort of topic for professional services firms. Lockup, how big is the lockup? Well, I mean, pretty much every firm managed to get their lockup down by a significant margin or significant factor, possibly because partners weren't travelling around, they were at home, were able to make the calls to clients to sort of encourage payment. Maybe clients were more sympathetic than they normally are, and probably a range of reasons, but nonetheless cash flow improved dramatically. And so within a few weeks it became evident that actually a lot of the liquidity facilities we'd been starting to arrange weren't going to be required, and actually firms were pretty much able to look after themselves, and if anything were accelerating payments to some of their key suppliers to support them with the challenges they were facing. So to answer your question again, Richard, I think it's to start broad and then drill down.
Yeah, Steve, we always say in the world of technology, it has nothing to do with the technology and everything to do with the people. And to sort of ask a group of partners to go out and staying with a lockup point for a minute, sort of, okay, let's make sure that you really do bring the cash in a bit quicker than usual. We're talking there about as much the relationships with you in the finance function and the partners as anything else. So how did you approach that sort of urgency in dealing with a need that had arisen externally?
Well, can I just quickly not answer that question in true political style, but to say that the banking industry reacted really positively and quickly to the whole pandemic as well. So whatever we firms were looking at, the banking industry was going to go through the same thing as well. So nobody knew what was happening. So I think the support for business as a whole was, obviously excellent. So then in relation to your real question, Richard, again, I don't think we were, as a firm, any different to anybody else. The pandemic started, and the perception of risk to your lockup obviously ramped up, whichever firm you were in. So you're looking at, okay, so some of our clients might get into financial difficulty, and we want to support them through that as well. But obviously, clearly, we want to crystallize what is due to us under the lockup. So our partners, I mean, I guess as you say, it does go back to your relationship with your partners, but and I think we have a good one. So you would expect me to say that, but I think by being very open with them at the start and going, there's a risk here that the assets that we have in that are not in cash, but which in relation to work done or debts unpaid, we need to ramp up the action on those to the extent that you weren't already doing it, to make sure that we crystallize that value. And I think it happened. I mean, nobody came round and said, no, that's ridiculous, there's no risk here, don't be stupid. I mean, it just seemed to happen, and our clients seemed to pay, so I think it was a sort of, everybody was in the same boat, whether you were client, bank, provider of professional services. It just seemed to be a sort of unspoken recognition that, God, this is really different. Nobody's been through this before. And, and maybe the initial panic of, whatever, if people were panicking, turned into, well, we either give up and go home or we carry on doing business until we can't. And nobody knew that at the start. And so people carried on doing business, and with a ramped up focus on lockup, which actually worked for most firms, as most surveys would tell us.
Sort of perhaps picking up that point. I mean, I think when you are in that, what I call, oh my God, nobody knows what's going to happen tomorrow. I remember in one of the surveys we did, we asked some finance directors, how far ahead are you planning? And they sort of thought 3 months was probably about as far as they were capable of going. Sort of reminds you almost of retail, where you don't quite know who's going to come in and buy stuff in your store next day. But it's not as bad as that. But now we're in a slightly more kind of a nuanced space. I think you could say we've just probably escaped recession based on the numbers that came out this morning, but maybe not, because they may revise them. And in a way that takes away some of the urgency, I sense, from the people involved. Oh, well, I've got to do that, help, or oh, well, it's okay, I'm sure it'll be all fine on the night. How do you, and again, either of you by all means answer this one, how do you actually, when things are just a bit full flat, how do you then generate that sense of urgency that really does matter?
Shall I go first, John? I think the issue is this is people like me can never stop on pushing on this. Obviously sometimes it's harder and sometimes it's easier, but until, I mean, we always make the point that until a bill has been paid, the service has been done for free. So and that sometimes has a strong effect, and sometimes it doesn't, but it really is a matter of keeping on it at all times.
And John, maybe perhaps more from the internal around the credit committee and the people who are making these decisions, and the extent to which they are going to do things differently when there's a lot of big changes, as opposed to, well, it's sort of business as usual, but at the same time things need to move forward. How does that work for you?
Well, I mean, typically our clients will always have requirements of us, because even in sort of fairly flat times, they're potentially still looking to bring on new teams, or maybe open new offices, expanding to new geographies, which typically always requires some funding. Going back to some points that Steve made earlier in terms of, sort of sharing information, which obviously allows us as a team to form a view, but then allows us to manage our own stakeholders. Things like KPIs. So what are the key KPIs that the finance team and the wider management team are using to run the firm are really helpful to understand. Obviously, lockup, cash collection, often forms part of that. And how is the firm tracking against those? And it's sometimes interesting that you can still have a management team that appears to have a fantastic handle on the business and how it's running, but actually those KPIs aren't really shared with the wider partner group. So they don't necessarily see that perhaps taking a more relaxed approach to collecting cash or getting the bills out is impacting on the overall performance of the firm. It's probably rare that all practice areas are performing well at the same time. There'll always be sort of areas of strength and areas where perhaps you'd like a bit more activity or high levels of utilization. And so we're fortunate, certainly in my experience, to have a very sector aligned credit team. So they know this stuff as well as I do, better in some cases. So it doesn't take much in terms of data points or, sort of directional messaging for them to get where we're coming from, where the firm might be. And I guess to finish, a key role for me and my team is making sure that the CFO, the person that's responsible for finance, and the team around them look good in the eyes of my credit colleagues, because that sort of trust goes a long way, particularly if there's an unexpected short-term requirement.
Thanks. Perhaps staying with that notion of transparency for a minute, and again, I'm being a little bit simplistic here, but I'm an accountant, and accountants are happy with numbers, and many people say lawyers are less happy with numbers, otherwise they might have been accountants. How do you, again, it's probably more for Steve, but how do you, when you're looking at the whole issue of transparency, I mean, you could probably give somebody a document that's 200 pages long and every month if you really put your mind to it, but I don't think you probably would want to, because it would be sort of glazed eyes and all the rest. So how do you get that balance right in terms of sharing, particularly for the partners that aren't as directly involved in the financial aspects of the business?
Well, I suppose a couple of very quick things. So firstly, what I view as our sort of key piece of monthly management information is 5 pages, and it got some various color charts. So so we have a KPI page, and I won't detail all those KPIs because that's not the point of the meeting, but we have a sort of a series of KPIs where we show our actuals against our budgets and our previous years and the month and so on and so forth. So making it as easy to read as possible. Obviously in relation to a report I might make, I just pick out a few points. Each of our teams has one of those reports, so we'll have, obviously it consolidates up, but each of the teams has their own report, and we have what I might call outreaches. We go out and we'll talk to our team leaders and say, here are the key points which I think are important to your team or to the firm as a whole, with the intent of trying to be helpful to point in the directions of where action could or couldn't be taken, or shouldn't be taken, sorry.
Wonderful. Well, I think I said right at the outset when we were chatting that the 20 minutes or the half an hour would go incredibly quickly, and I look at the watch and gosh, we're nearly there. So I think it's probably now time to wrap up quickly, if I may. And I'd like to thank John, first of all, for reminding us that we're talking about multi-stakeholders, that it's not just your bank, but your other equity providers and others who maybe could be as much as even 85 or more % of where the funding has come from, the importance of communication, of transparency, and that firms are pretty well prepared, but also very curious about what's going on elsewhere. So that keeps him very busy, I suspect. And I'd like to thank Steve for giving us, as always, a very helpful insight. We explored a couple of areas, but reinforcing those points around trust came through very strongly, getting the support of those people. And I think most fundamentally of all, no surprises, because if there's one thing that is bound to really put a relationship in a bad place, it's saying, whoops, I'm sorry, I meant to tell you, but I didn't get around to it, or some equivalent conversation. So hopefully that won't happen for anybody on the call. I've noticed everybody who started the call is still with us, which is pretty amazing. So obviously that means the show today has been great. So thank you. That's the best feedback I can give John and Steve. And on which happy note, I wish you both a brilliant day, and everybody else will be back in a couple of weeks, and we're looking at technology with a couple of people who are going to give us some tips on how you can actually use the ridiculous, excuse the word, the extensive investment you've made in technology to benefit rather than ending up with lots of pretty toys on your desks. Anyway, I will leave you all now, and thank you again, and have a wonderful weekend when you get there.
Thank you.
Bye for now.
Thanks very much. Bye-bye.